From a testability perspective, this slide is extremely important. It is showing us the impact of the choice between straight line depreciation and accelerated depreciation. If you have done the example, then this table will make a lot of sense, but in any case, I will give you the essence or the core points behind this table. Depreciation expense. For a company that uses straight line depreciation, the depreciation expense in the early years is going to be low, whereas the depreciation expense for the company that is using accelerated depreciation is going to be high, and we just saw that in the example. Obviously, for the straight line company, if the depreciation expense is low, then in the early years the net income is going to be high relative to a company which is using accelerated depreciation. The asset value is also going to be high because the depreciation and accumulated depreciation is relatively low, which means the asset value, which here is the carrying value or the carrying amount, is going to be relatively high for the company that is using straight line depreciation. Obviously, if assets are high, then equity is high, and we can see that using the basic accounting equation. Equity is assets minus liability. Assets are higher, liability is not impacted by the depreciation method, so equity would be higher for the company using straight line depreciation. Return on assets, this is the net income divided by assets, or it could also be operating net income, in which case we would have the operating return on assets. This would be higher for the company using straight line depreciation. This is a little bit tricky. We have said that the net income is going to be higher, and we have said that assets are higher. So both the numerator and denominator are higher. But hopefully what you have recognized through the example that you just saw, the degree to which the net income is higher is much more. So this percentage by which the net income is higher is much more than the percentage by which assets are higher. Notice we are talking about total assets here. The equipment is just one component of all assets. So even though equipment value is higher, but it's higher by a little amount. So assets are higher by a relatively small percentage, whereas net income is higher by a large percentage, which means that this ratio, net income over assets, overall is going to be higher for the company that is using straight line depreciation relative to a company which is using accelerated depreciation. For the exact same reason, the return on equity is also going to be higher for the company using straight line. Asset turnover is going to be lower. Asset turnover is sales divided by assets. Sales are not impacted by the choice of depreciation method. Assets are higher for the straight line method, and therefore the ratio, asset turnover ratio, is going to be lower. Operating profit margin is going to be higher. This is because operating profit margin is your EBIT divided by sales. Sales are the same for both companies. The EBIT is going to be higher for the straight line company because the depreciation expense is low, so the operating profit is relatively high, and the ratio then is going to be higher. These relationships will reverse in later years. The point being that what we have discussed over here is related to the early year of an asset's life, where the depreciation expense is lower for straight line, higher for double declining balance. As long as the firm's capital expenditures are declining, in the sense that the firm spends a lot of money on assets up front, initially the depreciation is relatively high for the company using accelerated depreciation, but then later on the depreciation amount for the company using accelerated depreciation comes down relative to straight line. That is only if capital expenditures are declining. If this is the case, then our relationships shown here will reverse. If capital expenditures keep rising, then obviously we will keep having a relatively high number for accelerated depreciation. Component method of depreciation. What you need to recognize here is that some equipment or some tangible long-lived assets might have multiple components where each component has a different cost and a different life. The question then becomes, how do we depreciate this piece of equipment with multiple components? What IFRS says is that companies must use the component method of depreciation, which means that each component needs to be depreciated separately. US GAAP allows component depreciation, but the method is seldom used in practice. Let us do a simple example. A machine has two components as shown here. The cost for component 1 is 10,000 and the cost for component 2 is 3,000. The useful life for component 1 is 10 years and for component 2 is 3 years. How will you depreciate? Using IFRS, where the component method is required, we need to calculate the depreciation for each component separately. For component 1, assuming a salvage value of 0, the depreciation would be 1,000. We are using the straight line method here, saying 10,000 depreciated over 10 years. So each year the depreciation is 1,000. Component 2 will be depreciated over 3 years. So here the depreciation cost is also 1,000. In year 1, therefore, the total depreciation amount is 2,000. If we treated this entire equipment as just one piece of equipment, then the cost would be 13,000. And if this equipment were depreciated over 10 years, then the depreciation in the first year would be 13,000 over 10, which would be 1,300. So notice that component method of depreciation would give us a different number relative to depreciating the whole equipment. Amortization and calculation of amortization expense. Amortization is similar in concept to depreciation. We've talked about this. The term amortization applies to intangible assets and the term depreciation applies to tangible assets. Intangible assets include customer lists, copyrights, patents, trademarks, software, etc. Intangible assets with finite useful lives are amortized over their useful lives. So this again is exactly the same as depreciation. If you have an intangible asset with a 10-year life and you initially purchase this asset for 1,000, then every year for 10 years you would depreciate 100, assuming the straight line method. Revaluation model. The revaluation model is an alternative to the cost model for the periodic valuation and reporting of long-lived assets. What we talked about in section 3 essentially was the cost model, where you initially record your equipment at cost and then you depreciate every year. The revaluation model, as indicated here, is an alternative, and the main point with the revaluation model, as this name implies, is that you are allowed to revalue the asset. IFRS permit the use of either the revaluation model or the cost model. US GAAP does not allow the revaluation model. So this is purely a IFRS concept. Revaluation changes the carrying amount of classes of long-lived assets to fair value. All this is saying is, if you initially purchase an asset for 1,000 and after 2 years the fair market value of this asset has gone up to 1,200, then you can revalue the asset up to 1,200, and then the depreciation will be based on this revalued amount. Companies need to be careful when using the revaluation model. This should be used when the fair value is very easily determined through market prices. If fair value cannot be easily determined and requires a lot of subjectivity, then it is better to use the cost model. As an analyst, you need to be very careful when companies are using the revaluation model because of the subjectivity involved in coming up with the new value. Carrying amounts with the revaluation model are the fair value at the date of revaluation less any subsequent accumulated depreciation or amortization. So in my example here, once the machine was revalued to 1200, then after that we do depreciate and the carrying value will be 1200 minus any accumulated depreciation. Let us look at an example which illustrates the concept of revaluation. A machine costs 10,000 at the start of period 1. At the end of period 1, the fair value of the machine is 12,000. So we have period 1, we start at 10,000 and then revalue at 12,000. In period 2, the fair value is down to 8,000, so we need to revalue downwards. How is this shown on the financial statements? Initially, our asset is shown at 10,000. After revaluation, our asset goes up to 12,000. So that's an increase of 2,000. How do we make the balance sheet balance? When the value of the asset goes up, we also need to show this on the equity side. On the equity side, there is a category called revaluation surplus that is increased by 2,000. Just as the asset value went up by 2,000, similarly on the equity side we need an increase, and that increase is shown as a revaluation surplus. This is a component of equity. In year 2, the value goes down. Now the fair value is 8,000. The asset has to be written down from 12,000 down to 8,000. So that essentially is a decrease of 4,000. How do we do this on the equity side? The first thing that we do is we reverse the revaluation surplus. So that comes down by 2,000. And then the additional 2,000, the difference between 10,000 and 8,000, that is shown as a loss on the income statement. 2,000, and then this flows through retained earnings, which also reduces equity. The overall impact would be that equity would be down by 4,000. Note that gains do not flow through the income statement. They go straight to equity and are recorded under revaluation surplus, whereas losses, and these are losses that take us below the original cost, those are shown on the income statement as a loss. In this example, we simply have the value going down first. So in period 1, we go from 10,000 down to 8,000. And then in period 2, we go from 8,000 up to 12,000. How does this work? Notice that in period 1, the value goes down. So the asset value goes down by 2,000. This decrease is shown as a loss on the income statement of 2,000. And then through retained earnings, we have a decrease in equity of 2,000. In year 2, there is a gain. With the gain, we first reverse the 2,000 amount. So on the income statement, we will have a gain of 2,000, and then the additional 2,000, which is the difference between 12,000 and 10,000, that is shown as a revaluation surplus, which is part of equity. So this 2,000 does not flow through the income statement. Impairment of assets. Impairment charges reflect an unanticipated decline in the value of an asset. Both IFRS and US GAAP require companies to write down the carrying amount of impaired assets. Impairment reversals are permitted under IFRS but not under US GAAP. A quick distinction between impairment and depreciation. Depreciation is a expected or planned decrease in the value of an asset. Impairment by definition is a unanticipated decline. If you have a piece of equipment worth 1,000 and because of an earthquake there is damage to this equipment such that the value is now down to 900, the decrease from 100 to 900 is called a impairment, and this loss is going to be shown on the income statement. Let us understand impairment related calculations in a little more detail, and then we will do an example. Under IFRS, the impairment loss is equal to the carrying value minus recoverable amount. Carrying value is the original carrying value of your equipment. Let's say that number is 1,000. After the machine has been damaged, let's say because of an earthquake, an unexpected or unanticipated event, the recoverable amount might be less than 1,000, which means that we need to show a impairment loss. The question then is, how do we come up with that recoverable amount? The recoverable amount is the greater of two numbers. Those two numbers are fair value less cost to sell and value in use. This term should look familiar. In the previous reading on inventory, we talked about the concept of net realizable value. That concept is used with inventory. The same concept is also used here, but it's just not called NRV. Here we call it fair value less cost to sell. If the fair value of this machine after it has been damaged is equal to 900 and it would cost 50 to sell the machine, then the recoverable amount is 850. So we compare 850 with the value in use. The value in use is defined as the present value of the cash flows that this asset will generate. Let's say that the present value of the future cash flows is 900. Then the recoverable amount is the greater of these two numbers, which is 900, and that would mean that according to IFRS, our impairment loss is going to be 100. Essentially, what we'll then do on the balance sheet is write the asset down from 1,000 to 900, and on the income statement we will show a loss due to impairment of 100. US GAAP is a little different. With US GAAP, we first do the recoverability test to determine whether the asset is impaired. An asset is impaired if the carrying value is greater than the asset's future undiscounted cash flows. If we say that the carrying value is 1,000 and we look at the future cash flows that will be generated from this asset, let's say that the future cash flows, the undiscounted amount is 1,050. Since this number is greater than the carrying value, then there is no impairment. On the other hand, if the undiscounted cash flows are less than 1,000, then we would say that there is impairment. This in essence is a litmus test which is telling us whether or not we need to worry about impairment. Let's say that instead of 1050 we had 950 as our undiscounted cash flows. That means that the asset is impaired. The next step would then be to compute the impairment loss. The impairment loss according to US GAAP is the difference between fair value and carrying amount. Let's say that you are given the fair value of 800 and let's say the carrying amount is equal to 1,000, then the impairment loss is 200. To understand this concept well, you can do example 9 from the curriculum. And what we have here is an example that is very similar to the curriculum example, and it will help you understand the concept. Let's say that we have a machine where initially the carrying amount is 8,000. The undiscounted expected future cash flow is 9,000. Present value of expected future cash flows 6,000, fair value if sold 7,000, cost to sell 200. What you need to do is say what value will be reported on the balance sheet under IFRS and what will be reported under US GAAP. And along with that, you need to show what the impairment loss will be that will be shown on the income statement. Under IFRS, here is what you need to do. You know that the carrying amount is 8,000. You need to come up with the recoverable amount. And if you recall from the previous slide, the recoverable amount is the greater of two values. One of those values is the fair value less cost to sell, that is like the NRV concept. The fair value less cost to sell is 6,800. We compare this with the present value of expected future cash flows. That number is 6,000. The recoverable amount is the greater of these two numbers, which is 6,800. On the balance sheet, we need to write down the machine from 8,000 to 6,800, and on the income statement we will show a loss of 1,200, which is the difference between these two numbers. With US GAAP, we need to do the recoverability test, and essentially what the test says is that you have to compare the undiscounted cash flows, which equal 9,000, with the carrying amount 8,000. In our case, the undiscounted cash flows are greater than the carrying amount, therefore there is no impairment. So US GAAP will say that we keep our asset at 8,000. Coming now to other impairment scenarios, I don't think this material is overly testable. It is covered very briefly in the curriculum, so I won't spend much time on this either. Impairment of intangible assets with a finite life. The rules here essentially are similar to what we talked about earlier with tangible assets. Impairment of intangible assets with indefinite lives. This essentially is referring to goodwill. We need to periodically test whether or not goodwill is impaired. Impairment of long-lived assets held for sale. Essentially, this is saying that if a company has equipment which was originally intended for internal use, but now the intent has changed where this asset is going to be sold or the intent is to sell, then it needs to be reclassified as held for sale. Reversal of impairments. We've mentioned this before, and this is a little bit important. Under IFRS, if you impair and the value comes down, after that for some reason the value goes back up, then you can revalue back up till the original value, even though the market value or the fair value is higher. But when you come back up, you can only come up to the original amount. Under US GAAP, you can go down, so revalue downwards, but then you cannot revalue up. And this should sound familiar. We talked about something similar when we covered inventories in the previous reading. Derecognition. A company derecognizes an asset, which means the asset is removed from the financial statements when the asset is disposed of or is expected to provide no future benefit from use or disposal. In other words, the asset is now useless. A company may dispose of a long-lived operating asset by selling it, exchanging it, or abandoning it. When a company sells an asset, the gain or loss on sale is equal to the sales proceeds minus the carrying amount. This is fairly straightforward. If the asset is sold for 12 and the carrying amount is 10, then we show 2 as a gain on the income statement. This is covered nicely in example 10, a very short and simple example, so you must do it. Long-lived assets disposed of other than by a sale. If you abandon an asset, this essentially is like a sale with zero proceeds. You would abandon an asset if it is now in a state where nobody is going to buy it from you and it is of no use to you. Let's say that the carrying value of that asset is 2. That asset is now being removed from the balance sheet. So the carrying value essentially is going to be written down from 2 to 0. 0 means that the asset has been removed from the balance sheet, and the loss of 2 is going to be shown on the income statement. Exchanged assets. You have asset A. This has been exchanged or replaced by asset B. What you do is remove the carrying value of A from the balance sheet. So if A has a carrying value of 10, B has a carrying value of 12, you remove 10 from the balance sheet and you bring B onto the balance sheet at the fair value of 12. So essentially you have total assets that go up by 2 in this particular scenario, because an asset worth 10 has been replaced by an asset worth 12. That gain of 2 is shown on the income statement as a gain. Presentation and disclosures, you can read this. I don't think it's overly testable, but as with other items on the balance sheet, there are requirements about what needs to be presented, what needs to be disclosed in the footnotes, and so on. I would suggest that you read this. Investment property is defined as property that is owned for the purpose of earning rentals, capital appreciation, or both. In other words, this investment property is not part of the regular operations of the company. Under IFRS, companies are allowed to value investment properties using either a cost model or a fair value model. The cost model is identical to the cost model used for property, plant, and equipment, but the fair value model differs from the revaluation model used for property, plant, and equipment. Under the fair value model, all changes in the fair value of the investment property affect net income. Under US GAAP, investment properties are generally measured using the cost model. Let us look at a simple example, and this is something that I have not seen anywhere else, but I thought it is useful to bring together some of the models that we have talked about in order to minimize any confusion. In an earlier reading on the balance sheet, we talked about unrealized gains and losses on securities that are tagged as AFS. Earlier in this lecture, we talked about assets valued using the revaluation model, and here we are talking about the fair value model. All these are models that allow us to define the value of an asset on the balance sheet, and these models also need to tell us how gains and losses need to be shown, specifically unrealized gains and losses. This is a bit of a revision, but with AFS securities, we essentially said that the asset is shown at fair value on the balance sheet, and any gains or losses are shown straight in equity. They do not flow through the income statement, so they are shown in equity as part of other comprehensive income. Then we talked about the revaluation model earlier in this lecture, and there we said that assets need to be shown at fair value when they are revalued, but there is a difference in how we deal with gains and how we deal with losses. Losses need to be shown as a loss in the income statement, whereas gains are shown as equity, so straight in the equity segment as a revaluation surplus. This is part of other comprehensive income. So notice with the revaluation model, gains and losses are treated slightly differently. We need to use both the income statement as well as OCI. With the fair value model, what we are saying is, obviously, since it's called the fair value model, the assets are shown at fair value on the balance sheet. And the difference here is that all gains and losses are shown on the income statement. So there are subtle differences between these three models, and on this slide we have summarized those differences. That brings us to the end of this reading. I will summarize the most important points. When you acquire a long-lived asset, you need to show the cost on the balance sheet, and the amount shown on the balance sheet includes the cost and all the money spent to put that asset into a usable form. You need to recognize that there is some subjectivity involved with certain expenses, and different companies might choose to expense versus capitalize. You as an analyst need to understand the impact that expense versus capitalized decisions have on financial statement elements and ratios. You need to understand the depreciation methods, and it's extremely important within this subtopic to understand the impact of straight line depreciation versus accelerated depreciation on financial statement elements as well as ratios. And then with impairment, you need to recognize that this happens because of unexpected events where the value of an asset comes down, and you need to know the IFRS rules for impairment as well as the US GAAP rules for impairment. These are the items that I think are most testable for your exam. As always, read the summary, go over the learning objectives. Most of the examples in this reading are good, and I have referred to them in the lecture, so try to do the curriculum examples. Definitely do the practice problems in the curriculum, and also do practice questions from other sources. That is it.